Welcome, everybody, to the Chinchilla Pickin' Podcast. It is August the 18th, 2024 at 4:12 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. I am David Underwood, and I am joined by the one and only, the incomparable, the Baron of Bonds, I don't know, the Brandon Beaver himself. Brandon, what's up?
Trying to get my microphone positioned right.
I
don't
see
know what
that.
the
You seem
deal
to be
is.
having trouble over there with your mic,
Yeah,
man. What's
yeah,
going
listen,
on?
I don't know. I can't get my laptop back far enough on the table. There we go. We're good now. All set
Are
up.
you settled? Are you set? Are you sure we're
Yeah.
good? Do we need more time?
No.
I mean, okay. I'm just, yeah. Whatever you need, man. Whatever you need.
You know what drives me nuts? And sometimes I know we've been a little bit guilty of this too, but I listen to a lot of podcasts and stuff, and I hope we don't do the same thing. But a lot of these podcasts and stuff, they go up and down in volume constantly. Like even like the most popular ones like the Joe Rogan Experience, for example, like they'll talk real low, then real loud, then they go away from the microphone and then they come right back towards it. And it's just, God, it's so annoying. Be more professional. I hope, I hope we're not
Well,
doing that. I know we did in the beginning, but if
yeah.
we're doing that, give me feedback on it. Let us know. I'll buy a headset or something so I keep the microphone right in front of my face.
So the only feedback I've ever gotten is that your mic is quiet and mine is loud.
Really?
Yeah, you're quiet and I'm loud. That's what some people say.
See, I listen to the show on the radio, like on my radio, on my Bluetooth radio, on my way to work on Mondays, and I don't get that. But if people are listening to us on headphones, they may have a different experience.
I haven't heard that in a while, but that's the only feedback I got. So if you're listening right now, uh, username Talismandine from Instagram, you have followed us from like day one. And I love that he DMs me every now and then. And I know you listen to the show because you DM me every now and then. You know, if you hear this, please let us know how it sounds.
Yes.
Because you've heard us over the years. He actually, if you are a follower of us, long time ago, I called Nvidia, and back when it was like $150 a share, pre stock split,
Yeah.
and he ended up buying. And I sent in our one of my group chats his comment back, like, "Yeah, I'm still holding that, and it's worth a lot more now." And he's very happy with his returns.
Amazing.
But yeah, you saw the comment, Brent. I shared it in our
And
group chat.
here's the point about if you got in at that good of a price, and what's the point of selling now? Even though, I mean, if you want to take the money, then fine. But what are you going to find that's a better deal than what you already have at this point?
That it does pay 1% yearly dividend.
Yeah, but the
He's
dividends
making a
are
minimum of
great.
1%.
And maybe cut some a little off the top if you want, because you probably will find some better deals in the market. But as far as like making more money with the money that you already have, but I don't see a point because I still think that Nvidia is going to grow over the next 10 to 20 years. I do think that we're in a bit of an AI bubble that we've kind of gone back and forth on, but the company is going to survive past that, and they'll grow into whatever the next big thing is. So
Right.
if you bought like a month ago, I would say probably sell. You probably have other things, and even if you're not in it right now, I wouldn't buy it. But if you bought in that early at that good of a price, you need to keep at least a position on it.
Yeah, for our listeners who don't follow pre-stock split and all that stuff, that would basically be buying in at the current stock price at $15, and it's now at like 115,
Yeah,
120.
yeah.
So
And
that's
at that
kind of
point,
the deal.
who cares about the short term ups and downs, even if it's a little bit volatile? You could even drop 20% on it, and maybe you just buy more. Who cares at that point?
Right.
Done so well.
But anyways, the whole point was, yeah, let us know. Give us that feedback. We appreciate it. We appreciate it a lot. We're in a lot of earnings last week, a lot of earnings coming up this week. I know you have some earnings you want to cover. I know I have some earnings. I'm going to intervene when you talk about one company's earnings, but I told you what I would say briefly, not directly. So, um, rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. We actually do not talk about it. We just give us the subject, the headlines, allow us to research it if we want to, and you hear the back and forth, the bicker and the banter right here on the show for you. So Brandon Beaver, go ahead, take it off,
Okay,
man.
so we got two companies here that I wanted to cover that I thought were very important for the consumer. We all know about the price of eggs. It's been highly touted, and the grocery prices and stuff. And one company that has its hands in all that's John Deere. We talked about it a couple of weeks ago, 2-3 weeks ago. It's farming. It's
Okay, no. I'm following. I'm following. Go
okay.
ahead.
Commodity prices up and down and stuff like that. It makes a difference to John Deere and soybeans and all of that stuff taking a big drop. And so is farming. We talked a few weeks ago about this, about how the farmer in the United States has seen their income on average drop 24%. Well, actually, overall farming in the United States has seen income drop 24%. Not good. John Deere did surprise a little to the upside here. For the third quarter, they reported a net income of $6.29 a share. The estimate was for $5.63. Net sales and revenue decreased 17% to 13.2 billion. But what's really helping them here is pricing power. They've got a nice little economic moat. One of those things that Warren Buffett and Charlie Munger, the late Charlie Munger, like to talk about was, if they're going to buy a company, they want a good brand and an economic moat around that brand that gives them some sort of insulation as far as pricing goes. John Deere has that. So sales in the agricultural segment, which included larger farm equipment, that fell 25% to $5.1 billion. This was due to lower shipment volumes. The impact was partially offset, though, by better pricing because they have that pricing power. They said they expect improved favorable price realization in the agricultural segments in 2024 compared to its previous target. So this allowed them to keep their 2024 budget, or what they were expecting to make. They're going to make it. In response to weak market conditions, they've taken steps to reduce costs and strategically align the production with customer needs. So they're undergoing a fairly large amount of layoffs and firings right now, which is a very unfortunate cost of doing business when it comes to the farming sector being in a recession. Go ahead, Dave.
So when they say realign production with customer needs, it means they're making less inventory,
Mhm.
and they're only making inventory they believe that the customer wants. So that's not always a. That's good that they're cutting costs in that regard, but that means they're going to have less inventory to sell. That means their top line number is going to be lower.
Right. This is
You
going to be
know.
a theme for me with both John Deere and Home Depot, by the way.
All right. Well, when we get to Home Depot, I have a counter, but go ahead.
Okay. So, a necessary reaction to bad economic conditions for John Deere. Their global workforce grew by 24% from 2013 to 2023, but employment in the United States and Canada has been flat for about 10 years. They've announced that they've laid off over 2,000 production workers. They've trimmed hundreds of salaried employees. And unlike previous downturns, Deere is now aggressively cutting costs and restructuring the business. Farming's not in good condition right now. I mean, we say the overall economy is not in a recession, but there are certain sectors of the economy that are, and farming's one of them.
So much I want to say right here. I could go down lots of different roads, but let's keep it stock and investment here. Um, so as an investment, you would probably want to keep your money out of farming and not be buying John Deere and be even indirectly invested in this. That's what I'm
But
getting.
they've had a 42% decline in sales for the last quarter, and the results were still better than expected.
Yeah, but the expectations were lowered, and they're going to be lowered again because they're having less inventory, so revenue is going to shrink some more. So it's, I
I mean,
mean,
they did maintain their full year outlook, but
yeah. So as long as they're profitable, that's good. But that means they'll be around after this is over with and come out the other side. That's all that means. But right now, I wouldn't look for any upside in the stock price unless you see a turnaround in the market.
I mean, they did just gap up about 8% after these earnings. So
Really?
Yeah, because it was better than expected. I mean, I think the price to earnings ratio was around 8.
Oh,
Would
that's low.
would have been a good time to buy. Now it's somewhere around like 10, 11%.
That's
So
still low.
yeah, it's still pretty low. I don't, but once you get like up to like 11, 12%, then you start kind of looking at fair value for companies like this that are very already mature. So I mean, it's a low price to earnings ratio compared to the rest of the market. The 8 was where you buy. That's where you would want to buy for sure. Um, it could give some of this back a little bit. Better than expected earnings, that's great. But still tough, tough, challenging roads ahead for John Deere. Honestly, Dave, if you look at it like this though, if you're wanting to buy and hold for 10, 15, 20 years, maybe even on anything, this is where you would want to buy. You would want to buy during a recession. You would want to buy during tough times, not when a recovery has been priced back into the stock.
All right. So yes, for a company that you believe in and that you are looking at anyways, and you've done your research and everything. Yes, yeah, you would want to buy in a recession, not when it's everything's going well.
Right.
I would not. I mean, me personally, I'm not going to buy John Deere right now, but it sounds like you're optimistic about it long
Uh,
term.
Oh, long term. Yeah, I'm optimistic long term right here. Um, yeah, I just so they're moving some production over to Mexico. That's causing some political, issues with them right now. A lot of politicians not happy about it. Um, and we've had falling prices for corn, soybeans, other farm commodities that are expected to continue to reduce demand for John Deere's equipment. But we do have a bumper corn crop and record soybean harvest. So even though prices are down and that record soybean harvest is probably going to bring soybean prices down even further, you're still going to want to, get every buck you can in off that stuff. So if you got a record soybean harvest, even with the lower prices, that's going to cause a little bit of a bump in demand, at least for John Deere, for the short term right now. So that's kind of the hope that continues to help sales a little bit so that they can meet their full year forecast for the year. Um,
So here's what I'm looking at. Like, so I did a pulled up real quick on uses of soybean in the United States, right?
yeah,
Because I'm like, why did so many farmers plant soybean and get an extra harvest, like an extra abundant harvest? You think everybody would be at least communicating, talking. I don't know, maybe not. I don't know how that the farming industry works too well. Even though I have family in it, I have family who are own thousands of acres of farm. And they're investing in it. But I personally don't understand it. So I Google real quick, USDA.gov, and on USDA.gov it says just over 70% of the soybeans grown in the United States are used for animal feed. Um, with poultry, chicken being the number one livestock consuming soybeans, followed by hogs, dairy, beef, and aquaculture after that. Also, soybeans are used in soy milk, meat alternatives, of course. We know where that goes. Protein bars use soybeans. And then lastly, soybeans are also used in rubbers, fibers, plastics, oils, so on and so forth. So forth. But number one is animal food, man. I guess they thought there's going to be a lot more animals grown or not. I don't know.
yeah. So you can use a lot for soybeans and corn. There's a lot that's used for both.
Yeah,
So
corn has a lot of uses, especially in the I know in Iowa, every time I drive through there, that's where my family is that owns the farms, the farmland. They still have a lot of what's that, the E85 corn gas,
yeah,
biodiesel, biogas type
yeah,
thing. Yeah, every time I drive through there, I see that everywhere. So it's used heavily there in the Midwest.
and there's cornstarch, which is in just about every food that you have and drink now these days.
Not anymore, man. I went on a no processed food diet, so I'll keep you updated on that.
Okay, but can you? I don't. Keep me updated. I'm interested in knowing how this goes because processed food is absolutely everywhere.
It is. But anyways, back to John Deere, soybeans, food. Yeah.
Yeah, I'm not buying it personally, but if you wanted to buy it, I'd be okay with it, is what I'm saying. It's not going in my portfolio, but I don't mind it going in somebody else's. So I would say it would be a good buy.
Let's
For
move on
now,
to Home Depot so we can have an argument.
depends, but it depends. So if you're going to hold it for 10 years, yeah, you buy John Deere right now, but you need to track it every quarter. You might get a better chance to buy. I think right now we had an 8% gap up on this right now. I think you're going to get another shot at it again, but we'll see.
No one, but so all the listeners that have DM back and forth over the years, or the ones that are in our group and everything, I don't know anybody who's gonna buy John Deere for 10 years. I mean, I'm just being honest. I'm speaking off the cuff. Maybe I'm wrong. DM us if I'm wrong, please. DM us, interact with us, let us know. I just posted something new TikTok too. Interact with that. But
I don't know
let us
about
know.
John Deere. I don't know about John Deere, but I know that we do have a number of listeners that buy and hold and don't
Do
trade
buy and
themselves.
hold, yes.
Tristan, for example, he's somebody that's going
Okay.
to have the diamond hands and hold over the next 20, 30 years, probably.
Yeah, he'll hold forever.
Yeah.
Yeah. All right.
Ready for Home Depot?
I'm ready.
I
I'm
don't know.
primed.
I don't know what
I'm
we're going to
primed.
argue about here, but they reported sales of $43.2 billion the second quarter of fiscal 2024. This is a 0.6% increase from the same period of 2023, so roughly flat here. Comparable sales in the United States decreased by 3.6% this quarter. The decline in comparable sales was influenced by higher interest rates and macroeconomic uncertainty, is what they said. Now, Home Depot has got an outsized um, exposure to the home market. So a lot of home builders and stuff like that use Home Depot, have accounts with Home Depot. So when we're not building new homes, Home Depot sales suffer. The stock has remained resilient. We had a little bit of a disappointing earnings just now, but still really didn't have much of an effect on it. Net
What was
income
their
for the
guidance?
net income for the fiscal quarter of 2024 was $4.6 billion, slightly exceeding Wall Street expectations. Despite the decline in sales, Home Depot's share price has remained flat, holding steady really since about 2021, and having good growth since then, despite sales not going for them. So I'm not buying Home Depot right now, and I don't think it makes any sense to buy Home Depot right now.
So during that time, let's talk about that growth with no earnings, no shares, stock price moving higher. During that time, you guys have revenue growth because during this time, lumber went way up in price, extreme values of price, and then way back, and then not all the way back down. They're still above where they were pre 2021. We used to see memes everywhere that a truck going down the road with lumber was like, "Hey, there goes $1 million worth of commodity driving down the road or what have you, because lumber prices skyrocketed during that period. So you have a growth in top line number revenue, but the actual profit, no, because their Home Depot's paying more for it.
Exactly.
They're
Yeah.
paying more from the supplier for that. So that's where you see the top line number going higher. It's growing as a company, but the stock price isn't moving because we're like, yeah, but you're not making any more profit.
Right.
Your profit margin's the same.
Right.
Well, it's smaller actually. So
Yeah.
that's the problem with that.
Here's where Home Depot is stuck. We can't get any more home sales because prices are too high. Right? So then people keep their own houses and stuff. And you would think, well, if people are keeping their houses instead of buying new houses, they're going to have to do renovations and things like that on it. However, interest rates are high right now. So you don't have a lot of people going to refinance houses or take out loans to do home construction projects right now because they can't afford it. So this is where we're at. Usually you have higher interest rates, home sales drop. We haven't seen that yet. Home prices drop. Let me say it like that. Higher interest rates, home prices drop because sales start to drop, right? We haven't seen the prices go down yet. So people aren't buying houses. Usually, if you have higher prices, you've got lower interest rates, but that's not the case either. So people aren't doing construction on their houses right now, and they're not, doing home remodeling projects because they can't refinance their houses at a 7% interest rate. Why would you want to do that? You got it at 3.5%, 4%, sometimes even lower. You're not going to refinance and double your interest rates. So nobody's doing home home improvement projects that they can't pay cash for, at least. And nobody's buying new houses right now. So Home Depot's in a rut,
Home Depot is in a rut. Home
but the
Depot's
stock
in a rut.
price isn't showing that. So I'm not buying it.
You're not all right. So here's where the convergence is showing here. So John Deere's guidance was lower, building less stuff,
Yep.
saying we're going to do worse.
Yep.
Home Depot, hey, we're going to continue to do worse. Home sales aren't good. There was another company, and I wasn't going to cover this, but after I heard you saying you were going to do Home Depot and John Deere, I was like, okay, good, and then I'll mention this.
Well, let me say this, because you're talking about they're not going to do good. Home Depot's not even sticking to their full year forecast. They were looking at 1% decline in sales. Now they're saying 3 to 4%.
Right?
So
So we transitioned to another company that reported this past week that's a little broader in their coverage of the overall economy, and that's Walmart. So this is one that last week I've said it consistently from day one. If I was going to buy any retailer, I would buy Walmart. I don't own any retailers. I don't own Walmart. But if I had a gun to my head and said you have to buy a retail stock, I would buy Walmart or Costco. That would be my second choice. Um, Walmart reported earnings, and the CEO on the earnings call was on there talking, and he basically said that, look, I would love to revise our number higher for the rest of the year, but because everybody else is revising lower, we're just going to keep it the same. But I believe we're going to beat. And he's saying we're seeing a strong consumer at Walmart. We're seeing more people coming in that are, again, over the $100,000 a year barrier mark that they track, which actually should be raised to 150, personally, I believe. Yeah, they're seeing more of a higher end consumer. They're seeing more consumers. They're seeing strength. Their grocery department area is continuing to grow. People are shopping at Walmart. Walmart is making money, and the profit margin is steady. So Walmart continues to grow and move higher on this. And I've seen the same trend the past few quarters. If you watch the stock, I'm not a chart guy at all. I hate guys going to look at the chart here and it tells you this, but I'm going to tell you, go look at the chart. Every time before earnings, Walmart stock is flat, and then right after they report earnings, the past few times, it just jumps right up because they're reporting great numbers and everybody else isn't.
yeah.
But there is, and Walmart saying the consumer is going to be stronger going in, and it goes into another article. I don't know if we want to get into right now, but I'm going to, by Goldman Sachs, and this is one that came out just this morning at 9:45 a.m. Goldman Sachs optimistic on U.S. economy and cuts recession risk all the way down to 20%. And that's for next year, saying that there's only a 20% chance of a recession risk next year. They're looking at the upcoming jobs report coming out September 6th that could potentially lead to a further reduction in the recession risk. So this is something that they are watching. Retail sales in July witnessed the most significant surge since early 2023. Government statistics revealed the lowest number of unemployment benefit applications since early July. They displayed increased confidence in the Federal Reserve's potential decision to cut interest rates by 25 basis points, and Goldman Sachs would know since half of the Federal Reserve used to work at Goldman Sachs. But they are still going to be watching for that jobs report because a disappointing jobs report could trigger a 50 basis point move. But they are optimistic on the economy. Walmart's optimistic on the economy. I looking at the data, I'm still up in the air. I don't know, man. I think this may be just one good company out of the bunch, but I'm 50-50 one way or another on the line. I don't know.
We're still at the tipping point right now. These things take time to progress right now, but we're still at the tipping point where it's going to be soon, where we figure out where we're going.
Yeah, but here's the thing: if Home Depot and John Deere are all expecting worse, and they're having less inventory, but Walmart saying, "Hey, we're going to be great," and they're the only company building up inventory, guess who's going to have a great third quarter versus everybody else? Walmart.
Well, yeah, because a lot of the consumers that would go to Home Depot to buy their lawnmowers are going to go to Walmart to buy them cheaper.
And Walmart will have the inventory versus other people are going to sell out
Yeah.
faster.
Yeah.
Walmart's going to have the excess inventory. Say, hey, we got it.
I
Come
just
here.
I just bought my lawnmower at Walmart actually.
See,
The
there you
Hypercut,
go.
they're supposed to be pretty good and they're cheap, so
And this is why I love Walmart, man. It's consistent, it's durable, yeah, and they sell that great value brand through Sam's Club as well.
yeah,
It's all the same thing.
my
And
lawnmower's got a Briggs and Stratton engine in it. But anyways,
right. So I mean it's a great company and I think they had superb earnings and I think that's for a reason. So
yeah.
I don't know. I think these other companies just aren't doing the right thing right now. And I think we're going to find out very shortly whether or
No,
not Walmart's making the right moves versus everybody
well,
else.
maybe the other retailers, as far as Walmart's other competitors like Target, for example, which has been on the downside for about 3 or 4 years now, ever since COVID. I think Home Depot and John Deere are making the right moves right now based on the macroeconomics that they're seeing for the sectors that they serve.
Well, we'll find out this week because later on in the show, I'm going to go through the full list. But Target, TJ Maxx, Macy's, all these other retailers are reporting this week. It's a heavy retail week.
Yeah.
But I mean, we're gonna find out when Target reports what their numbers are, what their profit margin is.
So it'll be interesting to see what Macy's says and what their next moves are going to be. The death of the mall is really that's a continuous thing that's been going on for like 15 years now. And Macy's is closing a lot of those mall anchored stores. So what is Macy's new business model going to be to try to get back to their, their peak?
Their heyday,
Yeah, and
their
how
heyday, their heyday. They weren't in malls. That's the thing.
and the other thing too for Macy's, they were one of the first retailers to really go and do the multi-channel thing and to call it multi-channel, and then it shifted to omni-channel and all that.
Yep,
They did the internet really well, and it still didn't work for them.
yep. See, Walmart just bought up. What was that company they bought up way back in the day? They bought up one of the internet selling companies that was trying to be a rival to Amazon, and Walmart just said, "No, we're just going to buy you and use your system that you already have in place."
Was it Overstock?
No, it was another one. I forget the name, but they already had all the systems in place, and so Walmart just bought them up and said, "All right, cool,
Yeah,
switch
well,
it
that's a
over."
good decision.
Right now, they're doing well. Now they're doing well. All right, so not buying Home Depot. I'm not buying Deere, even though Deere long term looks good. But Home Depot wait for the housing market, which I think we got to get. People don't have the discretionary income to buy homes. People coming out of college right now, most of them don't have a down payment, 20% down payment on a home, and they don't make enough in order
Right,
to cover that mortgage payment. It's very tough market out there
right.
for housing, and the commercial real estate market's still getting through its troubles, which the big banks have said that they can withstand the commercial real estate market troubles just fine. There'll be some write downs, but if you have a housing market collapse on top of it, then now you got some trouble.
Yeah. Well, the weird thing is a 25 basis point cut of interest rates, and you can't do it all at one time. But cuts aren't really going to help the housing market right now. It's going to drive prices back up.
Not
So,
25 basis points. Yeah, no.
and maybe you can get interest rates down to make the prices make sense, but I don't know. We'll see. We got August 23rd is Jerome Powell's speech at Jackson Hole. I think a lot of investors, at least the big time investors, are going to be watching that.
Right? I wish I could be there. Jackson Hole's beautiful.
It is.
All right, Brandon, what else you got?
That's everything I got, other than my final thought, which I do have lined up this time.
Oh, you already got it
Yeah,
ready? No
yeah,
way.
I'm
I'm
locked and ready.
excited. I'm excited. All right, so Goldman Sachs is optimistic on the economy. Walmart CEO is optimistic on the economy. Um, there's a lot of reason to be optimistic. The consumer is still buying, even though I've covered, like, it was about 3 weeks ago. I covered that the household total debt was, and this may be one of our deleted episodes, but our household total debt was the highest it's ever been. Credit card delinquencies is up extremely high according to the Philadelphia Federal Reserve that tracks this. It's extremely high. But people and some credit card companies have stopped issuing subprime, but there's still other subprime lenders out there, and so people are still able to get more credit cards and more loans.
Yep.
And it's crazy. So they're just running up more debt here in order to maintain that lifestyle that they want, and maybe the groceries and all that. But that's what's keeping the economy afloat right now is debt.
Not good.
Yeah,
Debt
and
all
the
around. Government debt, personal debt, all very high.
that and the actual savings, the average savings per household, personal savings is down by another 7% as well, is what I covered. Now, given all that, like I said, Walmart's still very optimistic. Goldman Sachs, optimistic. A lot of people are turning optimistic on the soft landing. And now you're hearing the analysts and the talking heads on CNBC, Bloomberg, and all them saying, hey, soft landing, soft landing, soft landing. That makes me worry.
It does me too, and here's why. Because 10% ago, when the stock market was looking like it was going to be in correction for a while, just a couple of weeks ago, everybody was on the opposite side. But now that we're back towards all-time highs again, everybody's thinking soft landing because it makes you feel good when the stock market's at all-time high, even if it is dislocated from reality, which I believe it is.
Yeah, and we've seen that before. We've seen stock markets move up where there was actually no fundamental base, and then you have a correction, and it corrects it, and it corrects things in the way they should be corrected. So, um, yeah, yeah. I mean, it's a wait and see at this point. Let's wait and see what happens. Let's see where everything goes. Um, I got a few things I want to cover here, and I want to make sure I get them in. But I wanted to let you know about what Goldman Sachs was saying and Walmart CEO. So you might have a good play there.
Okay.
All right. All right, moving on. Um, this one is retail pharmacy. So retail pharmacy, if you don't know what I'm talking about Walgreens, CVS, Rite Aid, so on and so forth. I found a great article, came out this morning, 8 a.m. I read it, and then I did a little bit of research as well. But I think, again, this is the second time I've loved an article by this author or writer or whatever you want to call them. But this writer is Annika Kim Constantino. So kudos to Annika because second one I've just really loved. The headline reads, "Here's why Walgreens CVS retail pharmacies are struggling and what they're doing to fix it." You going in to read it, and you read about how Walgreens CVS, they went from endless store expansions to now shuttering hundreds of locations around the U.S. The biggest problem has been fallen reimbursement rates for prescription drugs. And several factors of pressure from front of store, such as inflation and increased competition. So here's the thing here. We have currently two presidential candidates that are talking about prescription drug costs and what's going on with prescription drug costs and what's happening here. And then you have Walgreens and CVS on here, and I'm going to quote the article here. Among the biggest problems for the chains are reimbursement rates for prescription drugs have fallen. So I'm going to read from here because they explain it very well and better than what I could probably explain it. Here it is. Much of the pain for retail pharmacies come from lower prescription drug reimbursement rates. Pharmacies typically buy their medications from a distributor and then get reimbursed by the pharmacy benefit managers or PBMs, the powerful drug middlemen. Also negotiate discounts with manufacturers on behalf of the insurers and create lists of medications covered by health plans. So the three largest PBMs or pharmacy benefit managers are CVS Health Caremarks, United Health Groups, Optimum RX, Cigna, and Express Scripts. They handle almost 80% of all prescriptions in the United States. Pharmacies have accused the PBMs of setting lower reimbursement rates, which in some cases mean pharmacies get paid less than the actual cost of buying and dispensing that prescription. So these middlemen are accused of offering take it or leave it contracts when they're negotiating with the pharmacies. Uh, Let me see here. Walgreens is saying there's no leverage, there's no negotiation power on the side of retail pharmacies. We've seen a consistent pressure on the margins on pharmacies over the years. When you look at a chart of, say, Walgreens operating margin since 2015, year over year operating margin, they were positive operating margin all the way until 2023, and then they went negative 5%. So now they're just losing money outright. Only 75% of all Walgreens stores are actually making a profit. That's 25% that making no profit whatsoever for the company. The CVS is the only one that actually still has a profitable profit margin, and that's because CVS Caremark is a PBM. So they have their own
Yeah,
PBM that owns them.
yeah,
So of course they're going to be profitable, but nobody
yeah.
else is profitable. This is why Rite Aid just last year had to go ahead and claim bankruptcy and close most of its stores. They still have some open, but they had to close hundreds of stores, and it was because of these PBMs and the cost of doing business. What does this mean? You also, it means a lot of things, Brandon. So, we take this and we think about, all right, you have these online prescriptions, we have these Amazon prescriptions, you have these ads for, hey, you can get your prescription through us, companies coming in, and they're doing, well, if you will, if you want to say that. Yeah, it hasn't just hit them alone, but it's eventually going to hit them all. But right now, consumers are using online pharmacies such as PillPack, which is the subsidiary of Amazon. They're also going to Costco, Walmart, Target, other places rather than the traditional pharmacy chains. And that's starting to grow, even though it's still a small portion of the total pharmacy sales. However, COVID really pushed us ahead because pre-COVID, you wouldn't have gone to CVS.com or Walgreens.com and ordered. You would have, gone into the store. Typically, most people would have, and now that's changed since COVID. Now people have other options. You have Roe out there selling certain prescription drugs and moving forward with that. But CVS said same store sales at the front of the store, that's non like pharmacy prescription stuff, was down roughly 4%. Walgreens said same store sales decreased 2.3% overall. So both are seeing a decrease in sales here. And Walgreens is more exposed because CVS operates their own PBM. But where you also get some of this bad news for Walgreens is also in their healthcare. So Walgreens tried to operate some healthcare issues as well, right? You go in there, you can see a nurse or get your COVID shot or what have you, and that actually took a hit. So let's go over some numbers. CVS retail pharmacy unit was the second biggest contributor to sales last year. The retail pharmacy brought in $116 billion, but the health services, that's where you have primary care. They call it Oak Street Health, which is actually under Caremark. They brought in 187 billion in sales last year versus Walgreens. The retail pharmacy brought in 100. The U.S. retail pharmacy brought in 109 billion, but they only brought in 1.8 billion from their healthcare. However, Walgreens invested over $6 billion in there to grow that healthcare by part of it buying Village MD and part of it building those structures inside the stores. And so they are losing money on that in the billions right now. And hopefully they're hoping in the future that's going to grow for them. But there's just too many headwinds here, I think, for Walgreens. And this really could be a sign going forward, I believe, for Walgreens that if they can't figure out some kind of deal or partner with a PBM, that might be they might be nearing the end within 10-15 years.
Well, you're looking at a fragmented industry where both Walgreens and CVS have had to make deals in the past in order to try to keep their lead and to gain market share on the other. Um, Walgreens with Boots, for example. Boots Alliance was a pharmaceutical and beauty retailer that Walgreens merged with, and then CVS with Caremark. And the funny thing about that was, if I remember correctly, Walgreens tried to make a deal with Caremark as well to try to get them. And then when CVS did it and beat them out on it, then Walgreens cried foul and then tried to pretend like they were monopolizing the industry and tried to get the politicians involved. And quite frankly, it is a little bit of a conflict of interest there. So I'm surprised it was allowed. I'm surprised the merger was allowed there.
It's because
Um,
they're the third largest PBM. They're not the first. So they
yeah,
said, well, there's other competitions for the PBMs.
I mean that's true, but now Walgreens has a say in the or not Walgreens, but CVS has a say and the prices. They're kind of on both ends of that spectrum and the negotiations there. Walgreens versus CVS is a very interesting story. There's a good podcast series on business wars. I recommend everybody that's listening to this go listen to that. And that's a good podcast in itself too. Listen to everything on business wars. It's really good. Um, but yeah, I'm not buying CVS. I'm not buying Walgreens. It's a very fragmented pharmaceutical industry. And a lot of people go to Kroger now or
Yeah.
Walmart or Meijer.
Yeah. I think the big winner here is Walmart, Target, and Amazon. And even that newcomer Row Health, I think is the company's name that you see the Hims and Hers commercials for, and all
Mhm.
those other kind of commercials. I think those are the big winners out of this. I mean CVS is going to be around still because again they have their own PBM. They own both sides of the shop in here, but Walgreens is just it's too many headwinds, and I don't see without them merging or getting bought out by a PBM or merging with one of them. I mean, where's their future at there?
They're gonna have to.
Yeah.
Yeah, they've been struggling for about a decade now. Walgreens has, and I mean, I go to Kroger for my and I use the Good RX, and Good RX usually beats out the insurance I have.
Yeah, I just do CVS mail.
Okay.
So but there you go. That's the current state of the retail pharmacy industry. It is not in a good state. There's a lot of headwinds. Walgreens is. I'll end on this. Walgreens is very optimistic about their what do you call it, the store brand, if you will.
Hmm.
They're seeing a lot more sales in the store brand, which brings them more profit. And it actually gives them a good a good good boost to their top line and bottom line numbers altogether. But it's not enough to recover from the loss in the healthcare sector that they tried to grow into, and they're not really making money yet.
And it's not a good macroeconomic environment for them either, because those convenience store types usually charge up for the convenience of being able to buy groceries there. And so if you go to buy stuff, from CVS or Walgreens now, and you try to go buy bread or pop or whatever from them, you're going to pay more, a higher price than what you would at Kroger. So why not just go to Kroger and get your groceries there for cheaper and get your pharmaceuticals at the same time?
Yep, there you go. All right, so I want to transition here into something that I cover from time to time. You may have heard me mention on the show if you've listened for any amount of time. It's a three-letter word called oil.
Liquid
I've
gold.
right, liquid gold. I want to cover the oil rig count, and I've covered this at times in the past, and I've seen this number fluctuate so much. And I've covered. I did a whole episode. I gotta find it, and hopefully I can find it, and I can do a post about what episode that is. But I did a whole episode on where it was at the start of each administration and what happened because the headlines at the time were where everybody was saying it was this, it was that, and I was getting questions because I was covering oil companies, and so I said, "All right, I'll cover this in the podcast," and so I covered it. So I know the numbers because I have done the research and I've looked into these, but I'm going to go into where it's at right now. So according to MT Newswires, and this came out Friday at 3:47 p.m. So 8:16, 3:47 p.m. The number of oil rigs in the U.S. fell by 2 for the week ending Friday. The actual oil count was 483. And gas count was 98 for rigs, gas rigs, oil rigs. Um, a year earlier, the U.S. had 520 oil and 117 gas. Overall, 586 operating this week. A year earlier, 642. But even before that, even go back a few years before that, we were up around 700, 800 total rigs in the United States, North America, even more. And the thing is that it's been a continual decline in the amount of rigs. Now, I did cover that these oil companies, how are they maintaining profits even though the rig count's going down? I did a whole show, not a whole show, about 15 minutes on the fact that they found new technology and they found ways to extract oil at a faster rate, at a better, to make more money per rig, which allowed the oil companies, because they were claiming that they weren't getting the permits they needed in order to keep the rig count high. They just innovated and they were able to pump out more faster out of each. But that means those wells are going to dissipate quicker than they would have before. So they still need to work on getting those permits in order to grow the rig count. Now, at that time, I said due to this, there's less services needed done on rigs, so I wouldn't buy. I would sell Transocean. Transocean was at $8 a share at that time. Ticker symbol RIG, and I said this is a sell. There's no need for this because rig count's going down, and Transocean went down to like $4. Now it's back up to like $5 a share. But the oil companies are still making their money because they found new ways to get more out of each well. So if the rig count continues to go down year over year, that's going to be a problem. It means we're going to continually have slowly rising oil costs and gas prices at the pump. Year over year, the average will continue going up. Right now, it's currently sitting at 76.75 per barrel on Friday. While that's for West Texas crude, that's WTI crude, or Brent was at 79.78 a barrel. Now, the International Energy Agency said that global oil demand is set to rise by less than 1 million barrels per day in 2024. So slower growth. Everybody's saying that the economy is going to be slower globally next year. A lot of people say the U.S. economy is going to be slower the rest of this year. But as you heard me earlier in the show, Goldman Sachs doesn't believe so, and Walmart doesn't believe so. And those are two big companies. And so I'm wondering, with the combination of lower rig counts, and if we don't have a slower economy, the price of oil is going to go real high due to demand versus supply. Demand's going to be higher than what everybody thought it would be, and the supply is just not going to be there to fill it. So the price of oil could go back up to above $100 a share, $100 a barrel, sorry, very easily if those things fall into place. Brandon, first thoughts.
Well, that explains the 23% decline over the past 12 months in Schlumberger stock as well.
Right? Yes. Well, I called that, and I was happy I called that. And I called it on the show for all of our listeners to listen to. Hopefully, they made money off that. But I mean, that was obvious.
Right.
That was obvious. I mean, they don't own the wells, and they don't own the oil. All they do is service wells and oils,
Right.
and they service all these things, and they get them running, and they find they make the drill the hole. They don't actually do, yeah, the other parts of it. So
Now we're in an area where it's a little bit less obvious as to what's going to happen over the next 12 months, because we don't know if it's going to be a soft landing or hard landing or what. We don't know where we're going from here. We just know we're kind of at a tipping point, and we're probably going to find out over the next couple of months. A soft landing would be good for a company like, what was the company you were just talking about?
Walmart.
Well, no, not Walmart. No, I mean, it would be good for Walmart too, but
Rig
yeah,
Transocean.
yeah, Transocean would be good, and it would be good for Schlumberger too. I'm not touching it because I don't know. I mean, I can never tell you what the future is going to be, right? I never know, but we're at a point right now where the uncertainties are kind of battling each other on both ends, and you've got big companies taking both sides right now of the
Yeah.
extreme. So we'll see where we're going to go from here. I'm still not, I still say, retail companies, big brand companies, things like that. You're looking at regular like even Kroger or Coca-Cola or Apple or Nvidia, you get good deals, you buy them no matter what's going to happen. But with oil, it's a different story.
Yeah, we kind of have to know where everybody's going, what the supply is, and where the demand is, because that's the biggest two factors.
Right.
And Apache's never recovered from to the pre-COVID levels, and that's a rig operator as well. They've never recovered back to those levels. That was one I regularly traded in the 2010s. Was Apache, and yeah, they just couldn't get back there.
Yeah, it needs to be a little bit more. There's always going to be uncertainty in the marketplace, but we need to be a little bit more certain for me to make a call, at least. I don't know about you. Where would
Yeah,
you be right now on Pacific Corp, but with it being whatever, $5 a share, I think you said. And
that's for rig
yeah,
Transocean. Yeah.
for rig, and then Schlumberger right now being down 23% year over year and at a price to earnings ratio of like 12. Where are you at on that?
I'm not buying rig and I'm not buying Schlumberger. I do own ExxonMobil.
Okay.
Just for full disclosure here, I own
Yeah.
ExxonMobil, but I'm not buying the other two. I would buy right now. I'm currently down on ExxonMobil, but off this news, I might go ahead and buy in and lower my cost basis a little bit, because if it's going to move higher, then I could actually. I'm not. I'm breaking even. Sorry, I just checked the updated share price. That's how often I check share price of stocks I own when I'm buying them for long term. I'm even on ExxonMobil, so I'm not going to buy more. But that's one that possibly could benefit from this.
Warren Buffett owned Occidental's been doing well for him.
Yeah, right. Exactly. He just sold some of those shares too, by the way.
Really.
Yep. All right, earnings this week. Let's move in. Sorry, I raised the volume. I went from like loud, soft. We just talked about doing that. Sorry, I just did it. Um, Earnings this week. Here we go. I said it's gonna be retail heavy, so make up some of the big retailers. Got Estee Lauder first thing Monday morning
No,
coming out of there.
no,
Lazy Boy.
no. Too much exposure to the department stores.
All right, fair
Uh,
enough. For home builders, you have Toll Brothers coming out on Tuesday. Wednesday is a big day. You got Target and Macy's and TJ Maxx
no,
on
no, no.
Wednesday.
On all of them. I will pay attention to the earnings.
All right.
Elf Beauty, by the way, if you're gonna go with beauty, I would go with Elf Beauty, but I would wait for a decline in the price because it's wonderfully managed. Elf is,
Right.
but
Well, yeah.
the
Yeah.
management's priced in.
Urban Outfitters also on Wednesday. BJ Wholesales on Thursday. And
Favorite.
I'm just covering just the retail here. Ross stores on Thursday as well, and Buckle on Friday.
No.
Those are the those are the retailers this week. Some other notables this week that I'm going to call out besides Toll Brothers, which will be good to get a sense of the housing, is Palo Alto Networks on Monday. I want to see what they say from this last quarter, because they also do the same thing that CrowdStrike does, and I want to see if that CrowdStrike event had any effect on them over this last quarter. So I'm going to be listening more to the earnings call
Mhm.
and seeing kind of the detail and seeing what they say about that and how that's going to affect everything there and how that's going to play out if they picked up any other customers related. You have Snowflake as well, but then Zoom video communications. So Zoom reports this week as well, on Wednesday. So
Okay.
some interesting plays this week, interesting things to watch. I'm not going to buy any of them ahead of it. I think Palo Alto is actually going to beat, because they're going to probably sign new contracts from people who left CrowdStrike, is what I'm thinking.
Yeah.
So they
A lot of
may beat.
man, a lot of angry people at CrowdStrike. It's
No,
not
no,
good.
that's actually Q3 numbers, right? Yeah, that's
Yeah.
Q3. So
Well,
that's not this quarter, but I mean,
it's
they
not
could
good.
guide higher.
It's not good when you have both Delta and Microsoft mad at you.
Right. Yes. So they could Palo Alto could guide higher, saying we're going to do great. We picked up a lot of new contracts in Q3, so that could be a boost tailwind for them there. All right, man. Is that time of the show, Brandon? Final
I
thoughts.
would like to pick up Alto Networks. It's been on my watch list, but it's never been at a price that I've been comfortable buying it at. So if we would to get, some sort of crazy thing happen and Palo Alto drop like heavily, I would You think so?
I'm
They're
calling
not.
it going up. I'm calling it's going to have a good earnings guidance.
So I'm
It
gonna.
doesn't matter what they did in Q2. They're going to guide higher because of CrowdStrike.
So I'm gonna be sitting at the station watching the train go further and further away from me, which is fine.
Yes. Yes.
Which is fine. What I'm watching, I think we're putting too much emphasis on the interest rates sometimes. Um, in general, when you're watching the market, the interest rates are just a good guide for you to know where you're at, or where you to in the market cycle. It's a good guide to know where you're at in the market cycle. But regardless, if you get a good company, you buy it. If it's at a good value, you get a good company. It doesn't matter where you think we're at. You know, how many times have we called recessions on this show? We've been right a couple of times, we've been wrong a couple of times. Flip a coin. I don't know what the future holds. I'm not Magellan. I'm not, you know, reading palms or anything like that, pretending to be right. I think a lot of people do that with the charts. We've talked about this on the show quite a bit. I kind of tune out when that Carter guy's on CNBC. When I am actually watching it and he comes on, I kind of turn it out because I feel like charts are just they're symbol they're kind of the way that humanity used to do with like rain dances and stuff like that, or reading the stars, or palm readings thing. I'm not trying to be offensive, Dave. I'm sorry. But palm readings, you're just trying to understand what's happening in the future, in the future and the now. It's just trying to understand. It brings you comfort to think that you know these things, but the charts are no better than palm readings most of the time, or reading the stars. I went by, I was at the flea market a couple of weeks ago, and we went by a soothsayer, somebody that, pretended to read palms and read futures and stuff like that. And I thought to myself, everybody's walking by that place thinking how silly it is, but most of the investors are going to go home and read charts and think that they know what's going to happen in the future. But really, it's the same thing. It really is.
There you go.
That's my final thought.
All right. So for those of you who are listening, wondering why Brandon said like Dave not mean to be offensive, not meant to be offensive. I gave him a look when he said rain dances. I am part Native American, a member of the Karuk tribe out of Oregon. Shout out Karuk.
Shout
But
out, crew. Yo, homies.
I joke and gave him that look when he said that. That's why he said that. Yeah. So this week, Palo Alto, I think they're gonna have good guidance going forward. I'm looking for them to have a good earnings. I'm looking for Toll Brothers to miss and go down. So sell Toll Brothers, buy Palo Alto would be what I would be looking at for this week ahead of earnings. And then as far as retail, I'm not a fan of any retail besides Walmart or Costco. And
Yeah.
Walmart already reported, and I don't know. I think Costco already reported as well. So, and both of them were good.
Yeah, it's been the same story for 4 years in retail.
That's
Those have
yeah.
been the companies to go with.
So
Not changing.
there you go. That's all I got. All right. So thank you for listening. Please hit the subscribe button. As always, we hope we have been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Have a good night.